Most home buyers shop by price, but the truth is your monthly payment is what really matters. So let's break down exactly what kind of house $3,000 gets you in today's market. Most home buyers assume $3,000 per month gets them the same house no matter the loan, and that's simply not true. If you're working with a $3,000 monthly budget, your options may vary more than you think depending on how you structure the loan. And that's because few realize how much down payment, loan type, and interest rate actually swing your purchasing power. So what I want to do is show you 4 very real scenarios that each land around a $3,000 monthly payment, as well as the huge differences in purchasing price they create. Now, as I mentioned earlier, I talked about walking through 4 real life scenarios. We're going to talk about buying with an FHA loan, just putting 3.5% down. And then we're going to talk about doing a conventional loan with 3 different down payments, one at 5% down, one at 10% down, and another at 20% down, so that you can see exactly how much $3,000 per month gets you depending on where you are on the spectrum. If you're somebody that has a large down payment of say 20%, or if you're somebody just coming in with the minimal down payment of 3.5%, which is exactly where I'm going to start in today's video. But before I do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated on everything about mortgage and real estate, please consider subscribing to the channel. So option number 1 we're going to talk about today is FHA loan putting 3.5% down. Now, FHA is probably the most lenient loan program out there when it comes to buying a home because they allow you to have lower credit scores. They also allow you to finance more debt, having a higher debt to income ratio than any other loan program out there. So the reality is you're probably going to qualify for more home using an FHA loan than you are with a conventional loan in many cases. Now, I don't want to get bogged down in how much you need to make in order to be able to make a $3,000 a month payment, but the reality is you probably need to make somewhere around $75,000 a year to be able to qualify for this loan with FHA. Now, something I didn't mention earlier in the video is not only am I going to tell you the purchase price in which you can afford at that monthly payment, but I'm also going to break down the monthly payment so you know exactly what it looks like regardless of the type of loan program you do. Now, when it comes to FHA, again, the minimal down payment is 3.5%, and you're going to need at least a 580 credit score in order to do that loan. So in the case of FHA, if you want to keep your payment around $3,000 per month, the max you're going to be able to purchase is somewhere around a $375,000 home, which is going to require a $13,125 down payment because that's 3.5% of the $375,000 purchase price that we mentioned. Now, one thing about FHA is they also have upfront mortgage insurance in addition to the monthly mortgage insurance you have. Now, if you're asking what is mortgage insurance is essentially an insurance that the lender charges in case you default on the loan. Because you're putting less than 20% down, the lender requires this insurance. Now, with conventional loans, they only have the monthly amount. With FHA, they have the monthly amount plus this upfront amount. And in the case of FHA, it's 1.75%. So if you're buying a $375,000 home, that upfront mortgage insurance premium is going to be $6,333. Now, one cool thing about FHA is they actually allow you to finance that amount. You don't have to come up with it in addition to your down payment. You can just add it back to your loan and actually finance it. So in the case of this FHA loan at $375,000, you're actually going to be financing $368,208. Because once you put the down payment in, you add the mortgage insurance back, that's going to equal that $368,208. So now that we have that, we need to determine how much the mortgage payment is going to be per month. Well, today's interest rates on FHA are sitting somewhere around 6.25%. Now, something to keep in mind, as that number changes, you're actually going to be able to either qualify for more home or qualify for less home at this $3,000 a month. If interest rates drop, you're probably going to be able to buy more home. If interest rates go higher, then you're going to be able to purchase less home. But in the case of today's rates at 6.25%, your principal and interest payment before any taxes and insurance is going to be $2,267 per month. Now, in addition to that, you're going to have property taxes. Now, this is one of those big variables depending on where you're located in the country. This number could vary substantially because here in Southern California, where I'm located, our annual tax rate is somewhere around 1.1%. Whereas if you go to Texas or Florida or New York or some of these areas, you can have property taxes over 2%. So just make sure you're using your local average when trying to compute these numbers so that you have accurate information. But what I'm going to do is use the nationwide average, which is 1.1%. So in the case that you buy a $375,000 home, that means your property taxes are going to be $344 per month. Now, on top of that, you're going to have that monthly mortgage insurance that we mentioned earlier. Now, with FHA, the monthly mortgage insurance is 0.55%. 9% when you're putting 3.5% down, regardless of your credit score. So in the case of this FHA loan, that means your monthly mortgage insurance is going to be $168.76, which leaves us one last thing that we have to add in, and that is your homeowner's insurance policy, which covers fire, theft, that sort of thing with regard to your property. So this is somewhat of a guess because depending, again, where you're located in the country, this number is going to vary. If you're in an area that is prone to a lot of natural disasters, a lot of fires, that sort of thing, this insurance premium is going to be higher. Whereas if you're located in an area that has less of that, then your insurance premium is likely to be less. But on a $375,000 home, your monthly payment shouldn't be more than about $100 per month, which gives us a total monthly mortgage payment with everything added in of $2,880. Now this is about $120 less than that $3,000 budget, which means if you wanted to push that budget all the way up to $3,000, then you could probably go up to a $380,000, maybe a $385,000 in some cases purchase price. Or if you're located in one of these states that have higher tax rates or higher insurance premium rates, then that's probably going to put you closer to that $3,000 a month if you're buying a $375,000 home. Now I know what you're thinking. Well, what if I wanted to go conventional and put 5% down? I don't want to do FHA. I'd rather go with a conventional loan and avoid, the upfront mortgage insurance premium if I can. How much can I get with $3,000 a month in that case? Well, here's the thing. It is going to allow you to buy slightly more home for that additional 1.5%. But it's probably not going to be quite what you think. Now, with that said, there's one thing that we have to factor in that's different than FHA outside of that upfront mortgage insurance premium, and that's a higher mortgage rate. With conventional financing today, your mortgage rate's going to be somewhere around 6.75% if you have the best credit out there. Now, remember, FHA was 6.25%, so this is a 0.5% higher in interest rate using a conventional loan, even though you're putting a little bit more money down. In addition to that, you're also going to notice that the monthly mortgage insurance is also going to be slightly higher with this conventional loan than it is with FHA, and that's because FHA mortgage insurance is actually relatively inexpensive, especially when you're putting such a minimal down payment. But when it comes to buying a home and only putting 5% down, you're going to be maxed out somewhere around $400,000 using a conventional loan putting 5% down. Now, one of the biggest differences in these two scenarios is this scenario is going to require you to come in with about $7,000 more towards the down payment, because in this case you're going to need $20,000 as a down payment, which means you're going to end up financing $380,000. Now remember, today's interest rates 6.75%, which gives you a principal and interest payment of $2,465. Now, just like earlier, we're going to use the 1.1% tax rate, which in this case is going to be $367 for your taxes. You're also going to have that insurance premium, I'm estimating to be about the same, somewhere around $100 per month. But again, you are going to have monthly mortgage insurance because you're putting less than 20% down. The lender's going to want that in place just in case you default on that loan. So in the case that you have good credit and you're only putting 5% down, that rate's going to be somewhere around 0.6%, which is going to give you a monthly payment of somewhere around $190 per month. And one nice thing about conventional financing is whenever you get 20% equity in that property, either by paying down the principal balance or it appreciating or some combination of both, you can actually get that monthly mortgage insurance removed. So, in the case that you have that equity, you can call your lender, get an appraisal, have that removed, and your payment would essentially drop by that $190 per month. But either way, as it stands right now, your total payment with everything included there would be about $2,931 a month. So when you compare this versus FHA to start, you're getting about $25,000 more in home, right? A higher purchase price, $400,000 versus $375,000. You're putting about $7,000 more down, and your payment's about $50 more per month. So before we move on to the 10% and the 20% scenario, let me know in the comments whether you think that's actually worth it. So let's now talk about buying with a conventional loan and putting 10% down. So in this case, you're going to get even more home. You're going to get reduced monthly mortgage insurance because you're putting more money down, but it's going to come with a much higher down payment than the other two options that we mentioned. In this case, we're going to be talking about a $425,000 home, which means to put 10% down, you need to come up with $42,500 towards your down payment, which if you're keeping track is about $22,000 more than the 5% down and almost $30,000 more than the FHA option. Now, in this particular scenario, the interest rate actually stays the same. So we're still going to be using that 6.75% mortgage rate, which is essentially where we are today on conventional financing. So once you put put that 10% down, you're actually going to be financing $382,500 at a 6.75% interest rate. That's going to give you a monthly mortgage payment of $2,481. Now, your property taxes are going to be slightly higher because you're buying a more expensive property, and using that 1.1%, your property taxes are going to be roughly $390 per month. In addition to that, you're going to have your homeowner's insurance. Again, I'm keeping that $100 number because I feel like that is still somewhat accurate in this price range, but you are going to have that monthly mortgage insurance that I mentioned earlier. It's actually going to drop to somewhere around $128 a month. Now, again, this is assuming you have good credit, but all in, that's going to give you a total monthly mortgage payment of $2,970, which is, again, $30 less than our $3,000 budget. Now, when you're comparing this to the 5% down option, this is going to cost you about $40 more per month. So my question to you is, would you rather have an additional 10% in the bank or $40 less on your monthly mortgage payment? Now, granted, you are getting $25,000 of more home in this scenario, but it comes with putting additional down payment and a slightly higher monthly payment. And that's why I think it's really, really important to start with a budget in mind. Now, in the case of this video, you started with a budget of $3,000 a month. That's essentially what you're trying to stay underneath to figure out how much home you can get, which I feel like is the right way to approach this, because many people just start in the pre-approval process and they ask the lender, hey, how much home can I afford? And the lender says, well, you can go up to $4,500 a month on your monthly mortgage payment based on your income. And then most people just go out and do that, right? Without actually creating a budget, analyzing it, and figuring out what they're comfortable with per month. But in the case that you're putting 10% down, trying to stay under $3,000 a month, you're going to be capped out somewhere around $425,000 using today's interest rates. Now, one thing I like to say with all of these videos is use them for novelty purposes. Don't just take my numbers, run with them, try to create your own calculations, or use today's interest rates because you heard me talking about it. Better yet, talk to a mortgage professional. You can actually work with our team directly. We've helped hundreds of people here on YouTube. We'd love to help you too. All you have to do is use that link in the description. We can guide you through the process, run scenarios for you, and ultimately help you decide which loan program is best for you. Now, the last scenario we're going to talk about gets you about $100,000 more home than the first scenario we talked about. And that's because of two things. One, you're putting a larger down payment. In this case, you're putting 20% down versus the 3.5% we mentioned earlier. And the second thing is you're also removing that monthly mortgage insurance. We're taking that out of the equation. So that's no longer one of the debts that's being factored in, which essentially means you go up a little bit higher in purchase price in this scenario. But in the case that we're putting 20% down, we can go up to $475,000, which is going to require a $95,000 down payment, giving us a loan amount of $380,000. Now, one thing you'll notice with the scenarios that we've talked about so far is that the loan amount has essentially been the same with the 5, 10, and the 20% down. The biggest variables really being the monthly mortgage insurance. But in the case of 20% down, we're still using an interest rate of 6.75%, which is going to give us a monthly mortgage payment of $2,465 a month. Now, again, our property taxes are going to be slightly higher because we're buying a more expensive home. In this case, it's going to be $435 a month. I kept the monthly insurance premium again at the same, somewhere around $100, giving us a total monthly mortgage payment of $3,000 per month. So now that you have the difference in these four scenarios, I want to talk about one of the questions that we often get, and that's, well, I have 20% down to put down, but I don't really want to put it all down. Should I go with a smaller down payment and a different loan, or should I put all I have down to lower the monthly payment? And the reality is, to each his own. You have to decide what is right for you. As I asked the question earlier, would you rather have more money in the bank, or would you rather have a lower monthly mortgage payment? Now, another question that we often get is, how can I buy more home without putting more money down? And while that might seem like a crazy question, there are a couple of things that you can do. Number one is focus on your credit score. Have the best credit score out there. Now, I know what you're probably saying, that's what I'm trying to do anyway, but here's the thing is a lot of people come in with lower credit scores trying to buy a home, and that lower credit score impacts the interest rate, which in turn impacts the monthly payment, which in turn impacts how much they can afford to purchase. So rather than rush into the home buying process, if you can work on your credit score and improve that credit score to the top tier, say above 780, you're going to get much more favorable terms, which is going to impact everything else. So if you're somebody sitting on the sidelines thinking, well, I can't buy it right now, or this is too expensive, start working on your credit, because that credit is going to impact you so much at the end of the day. And the second thing that can impact this just as much is interest rates. As mortgage interest rates move down, it's going to allow you to purchase more home with that same budget. But the converse is also true. If mortgage rates move up, you're also going to be able to buy less home. So rather than worry about mortgage rates, again, focus on the things that you can control, which are your credit score and your down payment. Now, before you leave, I'd like to ask you a question. If you had the money to put 20% down in this scenario, would you actually go with the top end of the budget or keep more cash in the bank and go with the FHA option, putting less money down? Do me a favor and let me know in the comments. So if you're someone considering buying a home and you're shopping on a budget, your loan structure matters a lot. So with that, I would encourage you to use that link in the description of the video, reach out to our team, go through the pre-approval process, let them run all of the different scenarios you qualify for so that ultimately you can pick which program is best for you and your situation. All you have to do is click that link below.